Hello and welcome to the Opes Wealth Management fourth quarter 2023 markets discussion. I'm Aaron Whalen, and with me today are portfolio managers Mark Duvall and Louis Odette. This has been a year characterized by uncertainty, more than most years, and really significant divergence in terms of what the market's different asset classes are telling us in terms of the direction of the markets. Louis, could you begin with an overview of what we've seen over the course of the last several months and really the shifts we've seen in the third quarter and then in October so far in the fourth quarter?
Yeah, the most notable driver has been the increase in intermediate term interest rates. So that's been pretty dramatic, going from below 3.3% back in April to just above 5.5% a few weeks back. And that's been accompanied by a sell-off in the stock markets. And really the way I'm thinking about that is that the two markets had been telling different stories, but now they're starting to tell the same story.
So given that backdrop, how have we then seen shifts in terms of asset class performance attribution, and how is that then translated into potential portfolio shifts?
Yeah, interestingly, stock and bond markets have fallen over the last 4 months, and not all that much differently among them. U.S. stocks are down a little bit more than 5%, with the smaller and mid-cap areas of the markets down a little bit more than that. Non-U.S. stocks are down 6 to 8%, so kind of right in between those two sections of the U.S. markets. And bonds were down a little bit less than 5%. The one thing there is that because it then, with the rise in interest rates, which is what causes bond prices to go down, we've then extended maturities in order to kind of capture a little bit of that extra return. Now, on the other hand, our private alternative investments actually generated positive returns over the last 4 months, and cash as well also had a positive return. Although the one risk with cash is a little bit of reinvestment risk, since at some point the Fed's going to lower rates,
right.
And so what people will get then thereafter is going to be likely to be quite a bit lower. So overall on portfolios, yeah, they gave up a little bit of ground in the last 4 months, but they're still generally positive for the year due to the nice returns that we saw right at the very beginning of the year.
So a litany of concerns that I think you could cite at any point. And normally, I think we've had you be more of the doom and gloom. We'll pivot to Louis to kind of spread that out. You have concerns about monetary policy. That's been dominating our conversations for the last year. Yeah. You have froth, particularly within certain aspects of the equity markets, which we've talked about a little bit. In your discussions as an investment team, and I see you often as I'm walking by the conference room, and you're in there discussing what's going on in the world. What are the key topics that we're talking about? Starting with you.
Yeah, I mean, I think the aspect about bonds. We've got the highest yield since the global financial crisis. That was 15 years ago.
Right.
And so, and another way to look at that is that during the midst of the pandemic, the 10-year Treasury got below 1%. And to Louis's point, it was recently up above 5%. And so, when it's trading 4.7 or so right now, that's just so much better of an opportunity set in bonds than, has been the case for a long time.
Well over a decade, yeah.
That's right. And then secondarily, inside of the stock markets, yes, U.S. stock around the index is a little bit expensive, but there's good opportunities in small caps, value stocks, emerging markets. And the reason why it's a little bit expensive on the index level is simply because more than 100% of this year's return in the U.S. stock market has been driven by 7 stocks.
And when you say more than 100%, meaning if it wasn't for the Magnificent Seven, the index would be negative.
Correct. Yeah. Everything else, the other 493
Yep.
stocks on average are negative.
Yep.
And so, and that's driven by, expectations of AI being great, and a moderate growth economy. Now, then the question is, what are we actually going to see around that? And Louis, why don't you then touch on, the Fed, the economy, and then what are some of the risks that are out there?
Yeah, well, it's certainly been an eventful year as far as highlighting risks in the headlines. So very recently, geopolitics have flared up again with the situation in the Middle East and ongoing events in Ukraine. Then we've also got China, who's having issues with their property market and seeing declining exports. And then it seems like a while ago now, but also in our backyard, we had a couple bank failures earlier this year.
I remember those just a little bit. Commercial real estate is one that I've been getting a lot of questions on. And when I'm driving into the Menlo Park office and seeing vacancy signs or talking to clients walking into empty offices, what are you seeing there?
Yeah, you want to be careful about painting all of commercial real estate with the same brush because it's a very diverse asset class. But certainly some parts of that market, namely office, are facing some challenges, particularly downtown office. Related to that, we're watching the consumer pretty carefully because a lot of the excess savings that had built up during the pandemic have now been spent. And kind of getting back to the monetary policy question, what's going to happen with short-term interest rates and how's the Fed going to act? I think that's a big piece of the puzzle. I don't think we're ready to declare victory in the fight against inflation quite yet, but there's been a lot of progress made. The labor market has been a little bit stickier with headline unemployment remaining below 4%, so very low levels. But if you look underneath the surface there's some signs of deterioration, whether that's in wage growth, job openings, or the quit rate, people moving from one job to another to get better employment terms. So all of that will be definitely on our radar as we head into next year.
And on the consumer spending side, we'll be seeing data here, the all-important holiday season.
That's right.
Well, thank you, as always, for your comments and perspective today. And thank you to everyone that joined us. We look forward to our conversations with you in the coming weeks and months and wish you a great holiday season.